Today, we're going to go over a few ways to build a hedge to protect your gains and to protect yourself against trade wars, lockdowns, inflation, antitrust litigation, government shutdowns, or whatever other reason that caused the market downturn. Now, before I get started, I'm not a financial advisor and nothing I say in this video can be construed as financial advice. This video is made solely for your educational or entertainment purposes. The first way to hedge a position is to buy a put option. For those of you who do not know what a put option is a contract giving the owner of the contract the right but not the obligation to sell or sell short the underlying security, typically in increments of 100 shares per contract. This illustration is a profit-loss chart of a put option at expiration for one contract of XYZ with a strike price of $100 a share and paid for with a $1,000 premium. The x-axis represents the price of XYZ at expiration, whereas the y-axis represents the profit-loss of the contract at expiration. As you can see, the maximum loss of the contract is the price of the premium, which occurs if the price of XYZ is greater than or equal to the strike price of $100 per share at expiration. More particularly, the value of the put option is 0 if the price of XYZ is at or greater than $100 per share at expiration. However, the value of the put option increases as the price of XYZ decreases. For example, the value of XYZ put option is $1,000 if the price of XYZ at expiration is $90 a share. In this case, the value of the put option would equal to the premium paid for the put option. If the price of XYZ further decreases to $50 a share at expiration, then the value of the put option increases to $5,000 and the put holder achieves a net gain of $4,000 after taking account of the $1,000 premium. The maximum value of the put option is $10,000 if the value of XYZ reaches 0 at expiration. This means that the maximum gain for the put holder is $9,000 after taking into account of the $1,000 premium. Now let's go over a real-life application. I currently hold 100 shares of Goldman Sachs. I'm up 24%, and let's say that I anticipate that Goldman Sachs will drop in the short term, so I'm going to purchase a put position to hedge against my long position. Here, multiple option chains with different strike prices and different expiration dates are displayed. Generally, and all else being equal, the price of the premium increases as the amount of time between now and expiration increases. For example, the bid of a Goldman Sachs put with a $360 strike price and 6 days till expiration is $2 per share, whereas the bid of a Goldman Sachs put with the same strike price and 13 days till expiration is $3.15 per share. Moreover, if you're buying to open a put option, the strike price of the premium increases as the strike price increases. For example, the bid price of a put option that expires on July 2nd or 6 days till expiration with a strike price of $360 is $2 per share, whereas the strike price of a put option having the same expiration date and have a strike price of $370 is $5.60 per share. This makes sense because the longer time you have till expiration, the longer you have for the price of the underlying security to move in a direction favorable to your position. And further, the higher the strike price, the more likely that the price of the security will close at or below the strike price. So you have to take the strike price and the expiration date into consideration when you're selecting which put option to purchase. Let me know in the comments below if you wish to learn how I balance strike price, expiration date, and other considerations when I select a put option. Let's say that I anticipate that the price of Goldman Sachs will decrease within the next month, so I purchase a July 23, 2021 or 27 days till expiration put with a strike price of $370. And let's say that I paid a premium of $11 per share or a total premium of $1,100 to purchase the put option. The maximum loss would be the cost of the premium, which is $1,100, and this would occur if Goldman Sachs closes at or above $370 at expiration date. The break even for the put option would be $359, or $370 minus the cost of the premium per share, which is $11. If Goldman Sachs dipped below $359 per share, then the put option would swing to a profit and gain $100 for every dollar Goldman Sachs drops below $359 at expiration. This gain would counter the loss of the underlying security of 100 shares of Goldman Sachs, which is $100 for every dollar Goldman Sachs dropped below $359. Essentially, for $1,100, the put option that I bought protects any further loss that would occur if Goldman Sachs dips below $359 by expiration. Buying a put option has multiple advantages. The cost of the option is typically a fraction of the price paid for the underlying security. In the earlier example I gave, it cost me $1,100 of premium to protect 100 shares of Goldman Sachs, which has a current market value of $36,800 from falling below $359 a share. Another advantage is that as a put holder, you're not obligated to sell your underlying security. Let's say that Goldman Sachs dropped to $300 a share at expiration. Continuing with the earlier example, my put option with a strike price of $370 would be worth $7,000, netting me a profit of $5,900 after subtracting the premium. If I believe that Goldman Sachs will eventually rebound, and the market and the stocks in general do move up over time, then I can sell my put option, collect the profit from the option, and wait for Goldman Sachs to rebound. The biggest disadvantage of buying a put option is the cost of the premium itself, which I forked over to the put writer. There is no guarantee that Goldman Sachs will drop by expiration, and if Goldman Sachs closes at or above the strike price, then I lose my premium. Also, as a put holder, I would need to predict the market direction and the size of the movement before the expiration date of my option. Finally, when you hold a diversified portfolio with multiple securities, it becomes difficult to determine how many put options to purchase and which put options to buy to provide an adequate hedge. Another method to hedge is writing a covered call. A covered call is a call option written or sold to open by an individual who owns an equivalent of the underlying security. Using Goldman Sachs as an example again, I hold 100 shares of Goldman Sachs, and if I think that the price of Goldman Sachs will drop, I could sell a covered call, collect the premium, and wait for Goldman Sachs to bounce back over time. And I can repeat this process multiple times and collect multiple premiums. Let's say that I think that the price of Goldman Sachs will drop next month. I can sell a covered call that expires on July 23, 2021, or 27 days till expiration, at a strike price of $380 and collect a premium of $600 or $6 per share. If Goldman Sachs closes below $380 at expiration, then not only do I keep my 100 shares of Goldman Sachs, I also pocket $600 of premium. At this point, I can sell another covered call and collect another premium. And I can continue this trend until Goldman Sachs eventually closes at or above the strike price that I picked for the covered call. Alternatively, if Goldman Sachs closes at or above $380 a share by July 23rd, then I can sell Goldman Sachs at $380 a share, which is $11.23 a share higher than the current price per share, thereby collecting a profit of $1,123 from the rise in the stock value of Goldman Sachs. And on top of that, I also pocket the $600 premium. One advantage of writing a covered call is being able to collect premiums. Generally, this process can be repeated over and over again if the price of the underlying security closes below the strike price at expiration. Another advantage of writing a covered call is that unless you pick a strike price that is in the money, then you can also profit from the underlying security, even if the underlying security closes at or above the strike price at expiration and your underlying security gets called away. In my earlier example, where I sold a covered call with a strike price of $380 a share, if Goldman Sachs closes above $380 a share at expiration, then I would also pocket $1,123 from the rise in the underlying security of 100 shares of Goldman Sachs. Regarding the disadvantages, one disadvantage of writing a covered call is that it is only a partial hedge. Let's use my earlier example again, where I wrote a July 23 covered call with a strike price of $380 and received a premium of $6 a share or $600. This covered call gives me a maximum downside protection of $6 a share. So if a sell-off similar to the one we experienced in February or March 2020 happened again, and Goldman Sachs tanks by 30%, then my maximum protection is still $6 a share or $600. Another disadvantage of writing a covered call is that in the event that the price of Goldman Sachs goes above the sum of the strike price and the dollar value of the premium that I receive on a per share basis, which in my previous example would be $386 per share. At that point, it would have been better for me to have just held on to the underlying security without writing the covered call. At the end of the day, writing covered calls is a good way to achieve a partial hedge and make money on the premiums from covered calls if you can size the market direction and momentum. Further, the premium you receive also gives you a margin of error from your predictions on the market direction and size. A third way to hedge is by buying stocks, buying buy-to-open call options, or selling sell-to-open put options of a volatility ETF. A volatility ETF typically represents the market's expectation for future volatility. Volatility typically inverses the market direction. It rises when the market drops, and it drops when the market stabilizes or rises. If done correctly, volatility can be a cheap way to hedge against market downturn. However, this strategy is typically used by more advanced investors since trading volatility typically involves buying call options or futures contracts on corresponding volatility instruments. Moreover, volatility does not always move inversely to the market or to the direction of your portfolio. This strategy may not be the right one for you if you're a new investor. A fourth way to hedge is by having a diversified portfolio. Listen, I'm a big proponent of big tech, and I've said repeatedly that I think big tech will outperform the market in the second half of this year. However, almost half of my portfolio is still in non-tech stocks. One hot news topic is inflation and its impact on the stock market. Financial services like Goldman Sachs and insurance companies like Aflac, both of which I own, tend to outperform during moderately inflationary periods. At the end of the day, you don't want to put all your eggs in one basket, no matter how much faith you have in your basket. Please let me know in the comments below what your hedging strategies are and how you prepare for the next market downturn. Thank you for watching this video, and please hit the subscribe and like buttons.